Hey everyone, let's dive right into this explainer and break down exactly how Wall Street works step by step. If you've ever felt like the financial world is speaking a completely different language, well, you're definitely not alone. Today, we're going to be your translator. We're going to explore the absolute pricing engine of finance, starting right from the basics so you can build a crystal clear, structured understanding of the global stock market. Sound good? Let's get into it. So, it's a super common feeling for a lot of us, right? Your everyday life happens in the local economy, but the news on your TV or phone is constantly focused on this intimidating, seemingly disconnected global financial machine. I mean, you work hard, you buy groceries, you pay your rent, that's your reality. But then you hear terms like market capitalization, or liquidity, or circuit breakers thrown around like we're all just supposed to know what they mean. Well, today, we're going to completely bridge that gap. To get there, we'll build up your knowledge progressively in 5 quick steps today. First, Main Street versus Wall Street. Second, creating shares through an IPO. Third, trading in the secondary market. Fourth, market intermediaries. And finally, number 5, keeping the market safe. All right, part 1, Main Street versus Wall Street. Let's start with the big picture by defining these two very different worlds of our economy. Think of Main Street as the real everyday economy. It's households, workers, local shops, your community. It's driven by employment, wages, and production. Basically, it's where you earn your income and pay your bills in real time. Wall Street, on the other hand, is a massive pricing engine. Yes, it's a literal street in New York, but it's really the shorthand for the major financial institutions and public markets of the US. Wall Street is all about expectations. The markets take assumptions about future growth, interest rates, and earnings, and they translate all that into asset prices today, often way before those changes actually hit Main Street. Moving on to part 2, creating shares, the IPO. Let's zoom all the way in to figure out why stocks even exist in the first place. When a company is growing and needs a ton of cash to expand, it has a choice. It can either take on debt by borrowing money, or it can sell off pieces of ownership to the public. That very first sale of shares to the public, that is an initial public offering, or IPO. And this happens in what we call the primary market. To really grasp this, let's actually look back at history. Imagine it's the 1600s. Global trade is just opening up, and building a massive merchant ship is wildly expensive. Almost nobody has enough cash to build a ship on their own, and honestly, even if they did, who wants to take on 100% of the risk of that ship sinking? No thanks. So, the ownership of the ship is divided into smaller, affordable pieces called shares or stocks. This spreads that massive risk among a bunch of different investors. And if the ship has a successful voyage, the profits get distributed back to those shareholders as dividends. It's pretty brilliant, right? So how does this look today? Say a modern company wants to raise $900 in cash. In their IPO, they offer 9 shares for sale at $100 per share. Boom. Once sold, the company has successfully raised $900 in cash. This total is its market capitalization. The investors get their shares of ownership, and the company gets the cash it needs to grow its business. Okay, part 3, trading the secondary market. Now, what happens months or even years later when that original investor wants to sell their share? Do they just give it back to the company? Well, actually, no. If a shareholder wants to sell, they go to a stock exchange to find a new buyer. This is the secondary market. Almost all the crazy activity you see on the news, the daily ups and downs of stock prices, happens right here. And it's so important to understand that trading in the secondary market doesn't affect the original company's balance sheet at all. Cash is just changing hands between everyday investors. This trading happens on major global exchanges like the NYSE and NASDAQ in the US, the London Stock Exchange, Euronext, Tokyo, Shanghai, and because of time zones, as one closes, another opens. It creates this 24-hour global system where news in Asia can affect American markets in literally minutes. You can think of this secondary market as a giant, incredibly fast auction. A buyer announces the absolute highest price they are willing to pay for a stock. This is called the bid, representing demand. At the exact same time, a seller announces the lowest price they'll accept for their stock. This is called the ask, representing supply. Let's look at exactly how a stock's price is created. Take a look at the buyers and sellers here. Buyer A is only bidding $99, but seller G is asking for $104. They are never going to make a deal. But check out buyer C and seller E. Buyer C is bidding $102, and seller E is asking $102. A stock's price is quite literally just the law of supply and demand matching up in real time. The market matches C and E, the exchange happens, and boom, the current stock price is officially $102. And since these bids and asks shift minute by minute based on news, stock values can fluctuate incredibly fast. Which brings us to part 4, intermediaries, making the market. Today, most trading isn't shouting humans on a floor. It's completely electronic. Computers execute millions of trades in milliseconds, so to keep this beast running smoothly, we need dedicated professionals. These pros are called market intermediaries, and they basically bridge the gap between buyers and sellers. Different exchanges do this a bit differently. Auction markets, like the New York Stock Exchange, use specialists to collect bids and offers to find that perfect equilibrium price. Dealer markets, like the NASDAQ, use market makers. These are firms or folks who actually hold their own inventory of a specific stock, ready to buy or sell it all day long. They provide what's called continuous liquidity, so you can always make a trade. Once they make the match, the trade is settled, meaning the cash and the shares actually swap hands behind the scenes. Whether they're a specialist or a market maker, these intermediaries are absolutely crucial. Think of them like referees in a massive game, just making sure the rules are followed and every play is fair. They keep the trading environment orderly even when things get super volatile, so everyday investors like us can actually trust the system. And speaking of trust, that takes us to part 5, keeping the market safe. Trust requires a lot more than just good referees. It requires strict rules and some really powerful safety mechanisms. Regulators are constantly monitoring trades to make sure everything is fair. One of the biggest no-nos is insider trading. Imagine a mining company discovers a massive new gold deposit, or two companies secretly plan a huge merger. The executives know this secret before the public does, right? If they were allowed to just buy up a ton of shares before announcing the news, they'd make a massive, completely unfair profit at our expense. Regulators monitor the market strictly to prevent exactly that kind of cheating. But what happens if the whole market just panics? Well, since the crash of 1987, and we saw this during the 2008 financial crisis and the 2020 COVID outbreak, exchanges have used stock market circuit breakers. These are automatic trading halts triggered by sharp drops in the S&P 500. Depending on how bad the drop is, the entire market can literally be paused for 15 minutes or even shut down for the rest of the day. It's kind of like hitting the pause button. It stops the automated panic selling, gives everyone a chance to digest the news, and lets people take a breath to make rational decisions. So, zooming back out, we can clearly see how Main Street and Wall Street are totally interconnected. Main Street businesses rely on Wall Street to raise the capital they need to build and grow, just like those 17th century ships. But at the very same time, Wall Street completely depends on the real-world success, the actual wages and the profits generated on Main Street to create investment opportunities in the first place. They are literally two halves of the exact same economic engine. We have covered a whole lot of ground in this explainer, from the creation of a stock in an IPO all the way to millions of trades being matched electronically in the secondary market. I want to leave you with this final thought. The stock market is not just some random casino. It's a highly structured engine designed to price the future. So next time you see a stock price flashing green or red on the news, ask yourself, what future expectations about our local, everyday Main Street economy is Wall Street pricing in today? Armed with this understanding, you can look at financial news with total clarity. Thanks for tuning in.